Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Welcome to the U.S. Markets Wrap with me, Ryan Huang. Well, let's take a look at how things shaped up last night. We've got stocks rallying after U.S. President Donald Trump agreed to delay tariffs of 50% on the European Union over the Memorial Day holiday weekend to July the 9th. So a bit of a U-turn on that. The can being kicked down the road. That's helped the Dow Jones Industrial Average gain over 740 points to finish at 42,343. The S&P 500 rose 2.1% to 5,921. Both indexes snap 4-day losing streaks. The Nasdaq Composite was the outperformer, rising 2.5%, as we saw tech names like Tesla seeing outsized gains. More than 9 of the 10 S&P 500 stocks were higher in the latest session. And to help us out this morning, we've got Mark Newton. He is the Chartered Market Technician, Managing Director, and Global Head of Technical Strategy for Fundstrat Global Advisors. Mark, how are you doing today?
Hello, Ryan. Good morning to you and everyone.
Always a pleasure having you on the show. Let's get things started first with getting a bit of an overview of where things are right now, because it does look like we've got a bit of a reprieve right now, helping markets go along quite, at least a bit of a bounce in the start of the week. What do you take away from the current risk appetite situation?
Well, it's been an extraordinary rally. S&P is up over 1,000 points just in the last 7.5 weeks. So very little evidence of any sort of consolidation or pullback thus far. Today, actually, in the United States, equity trading, meaning last night, managed to show some very promising gains to multi-day highs ahead of NVIDIA's earnings. And, honestly, the risk appetite has been very slow to turn more optimistic, given the fact that tariffs are still very much ongoing. People remain skeptical that this kick-the-can-down-the-road approach is going to lead to tariffs being erased, and they're right, of course, but also it's just right to pay attention to technology's comeback, which has really been impressive at a time when rates have also started to pull back in recent days. So overall, I'm very optimistic for a move back to new all-time highs eventually. But I think between now and mid-June, we still push up a little bit higher to 6,000 to 6,150 or so before finding any sort of meaningful resistance.
Okay, so by and large, it does sound like the uptrends are still intact. So you're looking at 6,100 for the S&P 500.
That's correct. Yeah, I think it might be more difficult to immediately break out to new all-time highs, but I do suspect that does happen into the summertime. So after some minor consolidation, which is probably a mid to late June event, I think at that time, S&P should start to turn back higher.
Okay.
So the tech strength is important. I think momentum and breadth have improved, and sentiment has only slowly started to turn less bearish. And so those are all still very big positives as to why markets can rally. And you have to couple that with the fact that the economy and earnings have actually been quite good. So while everybody's concentrating on tariffs and could be underexposed to the equity market, things are going along just fine in the last few weeks.
Yeah, Mark, talking about consolidation, let's talk about some of the tech names here. Apple has been focused in recent days because of the commentary around how Donald Trump has been trying to put pressure on them to make more phones in America versus maybe in India or elsewhere. In that sense, it's been going through some headwinds. Where's it right now? How does it go and trade from here?
Well, it's been at a very choppy range over the last month. So Apple at right around $200 does need to show a little bit of improvement before one can say that it's going to trade back up towards the highs. So it has been a little bit of a laggard. It's come under increasing amounts of fire. And, Tim Cook's relationship with Trump has really been very good in the last 8 years. But now it's going to be up to Cook to really negotiate and try to explain how he might bring at least some type of manufacturing back to the U.S. And so it's going to be a tricky sort of dance. But in general, I suspect that he'll be successful and that Apple really can start to reignite its former rally. And once above 214, then it should have a little bit of a cleaner path towards rallying. But right now, it's just been a little bit choppy of late.
All right, hopefully the worst is over for Apple, and there is more good news in store for the stock or the company at least. All right, taking a look at what else we could be due for in terms of good news is maybe China with more stimulus measures. To what extent are you expecting more stimulus measures, and how is that going to help with all the asset classes in the market right now?
Well, I think with regards to China, I think they badly need stimulus. The demand picture seems to have fallen off a bit, but, the stock market has actually still been acting pretty well since early April itself, and things like FXI or KWEB as sort of vehicles, ETFs that can measure China have still been doing okay. And we have to remember the U.S. dollar remains very weak in the short run, and so that's actually helping quite a few emerging markets to strengthen. We've seen it in India, and we've seen it in Mexico, and even China have been showing, slow but sure signs of recovery. So, I'm actually encouraged by the fact that copper broke out last week, and we saw a similar move in silver. And I think the fact that the commodities are starting to rise and China's appetite for commodities is something we need to, continue to watch carefully. But that's actually pretty optimistic in my view for, a continued move to the upside in China's equity market as well.
Yeah, so the move in commodities also, I suppose, is a good sign in terms of where expectations are for a recession. I suppose that's something you're not penciling in as a base case right now.
I think it's premature to speak about the R word and think that's going to materialize in 2025. Earnings remain very, very good, and so is the economy. And so we need to see more deterioration in the labor market and I think housing before we can really think that a recession is upon us. I suspect that people have gotten a bit too pessimistic in recent months and need to concentrate on really a lot of the positives. Inflation has been coming down. Even if it bounces briefly, we know that the impact of AI is certainly going to be very deflationary. So that, coupled with the fact that crude oil could be headed back down towards $50, that's good news at a time when rates are starting to pull back a little bit. And so, I think it's more of a Goldilocks type environment right now, while the consumer is still, dealing with these day-to-day tariff headlines and not sure what to make of it. But, one should really ignore a lot of the politics and a lot of the exogenous events and really concentrate on really technical analysis, of course, and what's happening as trends start to improve. And you look at that along with the earnings picture and the economy, and all of those seems to be in much better shape. So I'm a glass half full type person, and I think that, it's right to still favor a move back to new all-time high territory this year. I think the S&P does get to 6650, but it will take some time.
All right, with the glass half full, where does gold fit in this equation? Because it's been seen as a bit of a safe haven of sorts, a hedge against inflation. Yeah. But at the same time, it's been outperforming equities.
Yeah, no, I think, interestingly enough, I think a lot of the outperformance lately might be given some of the fiscal unrest and the concern about the ongoing spending levels in the U.S., and really neither political party wants to address that. And so, that's coming directly ahead of us with the tax bill, and we'll see what the Senate does to help try to push that over the finish line, and probably in early July. I like gold, I like silver. I think precious metals are still very, very bullish, and they're a great source of diversification for those that might be a little too top-heavy in technology. And so I do like the fact that the Fed is still planning on cutting at least twice this year, so we're in a rate-cutting environment. The metals should be able to prosper and thrive. So I like gold, but I think silver actually is more interesting to me as one that can play catch-up. Gold has gotten very overbought. I still expect gold can get to 3,800, but I think silver is going to start to push up towards the low 40s in the months to come. It's entering a very seasonally bullish time between the summer and the fall, and so, I do favor exposure to the metals.
All right, for some context, silver is up 15% year-to-date. Gold is up some 26% year-to-date. What's the best way to exposure to silver right now? Is it through the futures or other proxies?
Well, that depends on one's own risk tolerance and time frame. It takes a lot of focus and patience in dealing with futures trading. We talk to our clients about things like SLV for an ETF that's based on the price of silver, or for those that have more risk tolerance, things like AGQ is more leveraged as a play on silver. That's also interesting. Or the silver miners, the junior miners, SILJ, is another interesting way to play that.
All right, a couple of ways to look at the markets right now. And we've been in conversation with Mark Newton. He's the Chartered Market Technician. Managing Director and Global Head of Technical Strategy for Fundstrat Global Advisors. Mark, thank you so much for your time and insights. It's been great chatting with you.
Yeah, my pleasure, Ryan. Thank you to you and all.
All right, catch up again soon. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.